Let's start this module with some reminders concerning the balance sheet and income statement. The balance sheet is made up of two sides, assets and equity and liabilities, which equal one another. The use of funds which appear under assets are equal to the sources of funds which appear under equity and liabilities. The income statement shows the income and expenditure recorded during the period. It groups together all of the operations that have made the business richer, income, or poorer, expenses. It's very important to note that at any one time, expenses are not necessarily outflows of funds, nor is income necessarily an inflow of funds. The point of time at which income and expenditure are recorded, at the dispatch or receipt of an invoice, is not generally the same point of time as that at which payment is made.
The difference between income and expenses, i.e. the balance of the income statement, is the business's profit or loss. If it is a profit, it is a source of funds that goes in the equity section of the balance sheet.
The point of being in business is to make a profit. The process starts by selling goods or services at a price higher than the purchase price for trading companies and higher than production cost for manufacturing companies. The survival of a business depends on its capacity to meet its financial commitments. In other words, always having funds available.
There would seem to be a paradox here, since a business, at a time that it is making good profits, may have an empty treasury and therefore be at risk of failing.
To understand this apparent paradox, we have to distinguish the concept of profitability from that of solvency. We have to understand the difference between profit and cash. Profitability comes from making a profit, while solvency comes from having a positive cash flow.
Profit and cash are not the same thing.
What's the effect of recovery of a customer receivable on the following items? Click on the movement affected by this transaction.
Profit or loss is not changed. The recovery of the customer receivable is neither a sale nor consumption. There is therefore no impact on income or expenses. The balance sheet total does not change. It is simply the transformation of one use of funds on the balance sheet to another. The customer receivable is transformed into available funds.
What's the effect of a partial repayment of loan capital on the following items? Click on the movement affected by this transaction.
Cash decreases because a repayment results in an outflow of funds. There is no effect on profit. This is in fact a typical balance sheet only transaction, since there is neither a sale nor consumption. Financial liabilities on the liability side decreases, counterbalanced by a reduction of the same amount in available funds on the asset side. The income statement is not affected by this reallocation of assets and liabilities. The effect on the balance sheet total is therefore negative. The total of available funds on the asset side reduces. This is counterbalanced by a drop in the total of financial liabilities on the liabilities side. This is an asset side, equity and liability side type movement.